You're watching Kitco News coming to you from New York. I'm Michelle McCory. Fed Chair Powell says that the Fed is not considering slowing the pace of its asset purchases and that it's not even time to start talking about tapering. Powell is also reiterating that inflation will be transitory and controllable. Joining me now to discuss this and more is the man who headed the U.S. Mint during the financial crisis of 2008. Ed Moy was the 38th director of the United States Mint, a position he held for a 5-year term under both President Bush and President Obama. And Ed is currently the chief strategist at Valerum. Ed, good to have you with us.
Michelle, thanks for having me. And that great introduction is not going to get you any free samples from the Mint today.
Well, perhaps next time. I'm building up cred, but I appreciate that that's how your head is thinking, Ed. Let's focus on what we heard from Fed Chair Powell, because he's saying get ready for higher inflation, but he's also saying don't worry too much about it because the Fed will be able to fix it very quickly. What's your take there, Ed?
Yeah, so he's saying that for several reasons that are interesting. The first one is the Federal Reserve has notoriously, over the last 10, 12 years, have had bad predictions on their inflation. They were always under their 2% target. And that's one of the frustrations that Powell has is being part of the Biden economic team. Most of the Biden economic team are Obama holdovers. And here is the different philosophy that Obama had that is passing on to Biden, which is all the stimulus that happened during the financial crisis, it took 8 years to begin paying off. And unfortunately, Trump benefited from that. And so this time around, they're not going to be shy. They are throwing the kitchen sink as far as monetary and fiscal stimulus at this, hoping that that growth is going to come a lot sooner. And so Powell's just not worried about inflation now, but the markets are saying a different thing. When you take a look at the sharply rising returns on bonds, that's signaling that the private marketplace is really concerned about inflation, and they're already starting to price it in on long-term debt.
Yeah, Ed, I mean, the Biden administration's approach, to your point, seems to be rather do too much and deal with the consequences later than do too little. But we are getting a lot of red flags about inflation. But surprisingly enough, we're not seeing this really reflected in the spot gold price. It was slightly up on the recent statement from the Fed, but we haven't really seen this inflation reflected in the spot price of gold. It's been struggling to break past the 1800 level since late February. So why do you think that is?
Yeah, very good point, Michelle. And I would point out too that the spot price is what's currently going on in the market today, but it's not really the full price of what it costs to buy gold. So if you go to any one of the top retailers in gold bullion and take a look at what they're charging for a 1 ounce American Eagle gold bullion coin, even though the spot price right now is $1,775, give or take, you're hard pressed to find a 1 ounce gold coin for anything less than $2,000. And I've seen it as high as $2,100. And so when you add that together, you are seeing a 20% premium if you can even find the gold coins to buy.
Well, yeah, you're absolutely right. I mean, there does seem to be a disconnect between spot gold price and demand for gold bullion. We're seeing a big premium in both silver and gold between the physical silver and paper silver, and as well to your point with gold. But I guess the question is, at what point does this premium catch up with the spot price?
Yeah, and I think what's artificially depressing the price of gold now is that there's a lot of institutional investors that don't hold gold. But what they do is they buy gold derivatives like futures and so on. And a lot of them are betting that the economy is going to recover, everything's going to be fine, and gold's going to go down. But as those short contracts come up, what you're seeing is a popping in price, just like it did last week. It went from 1730 to maybe 1785. And I think over time, you're going to see much more of that, especially that since that not only the US Mint, but also other mints around the world, Australian's Perth Mint, the Mexican Mint, have all run out of gold. They can't keep it in stock, and retailers can't. There's so many shortages, retailers are having problems accessing that gold.
All right, so given that the demand is there, and to your point, there are struggles with supplies, at least from a mint perspective, what does it mean for the price? What is your outlook for spot gold over, say, the next 6 months or so?
Yeah, that's another good point. And I would just point out that Goldman came out with their report today, and they think gold's going to go up to 2,000 over the next 6 months. I think that's a fairly reasonable prediction. It might even go up to 2,100. Because when you look at the price of the premium that it takes to buy a gold coin today, I think the true market price of gold is between $2,000 and $2,100.
And that's the current price as reflected with a premium.
Yep.
So stands to reason if there is more demand, then that spot price should be even higher.
Yes. Yeah. And so I'm a little conservative, but I do think there's a lot of unknowns out there. And so, but I do think that you will see gold prices appreciate at a fairly good pace from now until the end of the year.
Well, Ed, you touched on this idea of there being a bit of a supply crunch, and that's led to some speculation, particularly with regards to silver, that there isn't enough physical silver to cover paper silver. We saw that debate sort of front and center during the recent GameStop Reddit-inspired silver squeeze attempt in February. So, I mean, what do you think? Is there enough physical silver to cover paper silver?
Yeah, I don't think so. I think there's a growing issue, and that's the same thing as gold. When you take a look at the gold that's in COMEX, that gold is leveraged somewhere between 60 and 85 contracts per ounce of gold. That makes a big difference because when you talk about individual investors, they don't have sophisticated derivatives to hedge. And so what they end up doing is buying the physical commodity. And so you might have an individual investor buy 10 ounces of silver or 1 ounce of gold. And that is such a small impact considering the gold that is already, or silver that's already leveraged. And so that's why I don't see a lot of fluctuations in price now. But as those derivatives come up to be called, I think you're going to see more and more future direction on increased inflation and people trying to cover their bets now because they know that price is going to go up later.
So, Ed, if I'm understanding you correctly, you do not think that there is enough physical silver and physical gold to cover paper silver and paper gold right now?
Yes. Yep. I do think that there's a gap.
So what would that mean if somebody were to try and reattempt a gold squeeze or a silver squeeze?
Yeah, I think, so I think the problem that you saw with the GameStop action on silver is that gold and silver are a much larger market to corner. I mean, even the Hunt brothers who tried to do it 2 decades ago had a really hard time. Yeah, but stocks are a lot easier because, when you take a look at like GameStop, there's just a certain amount of shares and you can put the squeeze on it. But when you take a look at gold, for example, is an $11 trillion market cap. It takes an awful lot of leverage to be able to corner the market on gold or silver.